You try to keep your expenses in line with what you earn. You balance your budget. Well, the government does something along similar lines. And there's good news for the North Block on that front. Gross GST collections in October have come in at about 1.52 trillion rupees. This is the second highest monthly collection ever, next only to that for April this year. It is also the second time that collections have crossed 1.5 trillion rupees. In short, revenues are up. That is the cherry on the cake since GST collections had remained above the 1.4 trillion rupee mark for the seventh straight month in September. Tax collections data for the first half of the current financial year were already promising. Direct taxes grew by 24%, while GST clocked an increase of 31%. Up to that point, the collection numbers boded well as far as the government staying below the fiscal deficit target was concerned. The FY23 target is 6.4% of GDP. Headwinds do exist. There has been a revenue shortfall on account of a reduction in excise duty on petroleum products. Then, there is the extra expenditure due to the extension of the free food ration scheme and an increase in fertilizer subsidies. But the government can breathe easy due to savings on account of lower food procurement and the unused funds allocated to a number of ministries. As a result, a confident centre has planned for a lower borrowing during the second half of FY23. The centre's fiscal deficit for the first half also came in at 6.2 trillion rupees, or 37% of the full year budget estimate. October also brought with it more good news on the consumption front. Maruti Suzuki, India's largest car maker, saw dispatches rise 21% year-on-year in October. But the growth came on a low base since a semiconductor shortage had cut into production in the comparable period. Mahindra & Mahindra's passenger vehicle dispatches jumped 60%. The company's tractor sales also rose 11%, despite analysts projecting a fall. While Tata Motors saw PV dispatches rise 33%, commercial vehicle sales fell 2%. However, Bajaj Auto's total dispatches fell 13% year-on-year in October. While weak exports proved to be a drag, domestic sales also rose just 4%. The reason may be, as brokerage firm Nomura projected, that the festival season demand remained K-shaped in October. While the first half has brought good news for the government, how will the second one play out? Bank of Baroda chief economist Madan Sabnavis says that for the second half, the critical factor is whether consumption continues at the same pace seen in the first half. The economy has really benefited from the pent-up demand syndrome. Notwithstanding high inflation, people have continued to spend, and that has reflected in the GST collection numbers. But Sabnavis says there is a question mark on whether people will continue spending given the fact that inflation shows few signs of moderating. While it is possible that this level of spending will continue in October and November, albeit with some weakness, there could be a tapering in consumption after that. Sabnavis says that this would also mean that the buoyancy seen in GST collections may not be sustained. A major part of spending on account of the free food program and further fertilizer subsidies will reflect in the second half of the fiscal. The budget deficit may then come under pressure as a slowdown is expected in the overall tax revenue. Sabnavis also says that while non-debt capital receipts at this stage may look impressive, achieving the 65,000 crore rupee disinvestment target requires an additional 30,000 crore mop-up, for which there are no concrete plans. The pressure on fiscal deficit may not be too significant, however, and can be contained at 0.2 to 0.3% of GDP, Sabnavis says.
Also, we should remember that in terms of non-debt capital receipts, which is primarily disinvestment, the number looks impressive because of one major disinvestment which we have had. But 65,000 crores is the target. We still need to do something like 30,000 crores. And as of now, we don't see any concrete plans for raising that kind of money. So to my mind, there would be some kind of pressures which would come in terms of upsetting the fiscal deficit number. However, it may not be too significant, maybe not more than 0.2, 0.3% of GDP. And we should also remember that the GDP number, which is the denominator, would tend to be exaggerated on account of higher nominal GDP emanating from higher inflation, because we use the GDP deflator out here, and therefore we could be getting a denominator which is increasing by 18 to 20% rather than 11%, which was projected by the government. So all this means that even if there's a slippage in the numerator, I think a denominator will provide a lot of cushion.
Going ahead, India won't be able to escape the effects of the projected global recession completely unscathed. Amid the external turmoil, healthy domestic demand could prove to be the determining factor for the economy.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.